Better System Trader, Episode 30.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast. This is episode 30, and I'm your host, Andrew Swanscott. This week's show is going to be a little different to previous episodes. A couple of weeks ago, I went back through all of the guests we'd had on the show so far and realised how very fortunate we've been to have so many fantastic guests on the show sharing their knowledge and experience. To be honest, I'd forgotten some of the topics we'd covered in the podcast so far, and going back through them was an excellent reminder of all the valuable information the guests had shared. So for episode 30, I thought it might be a good idea to revisit some of the key points in the earlier episodes so that those that maybe haven't heard them will go and listen to them, and those that already have listened may get some value out of hearing some of the ideas again. I know when I went back through them, it reminded me of some things that I wanted to test or investigate further, and I really found it a valuable exercise, so I hope you do too. So this episode will cover some of the highlights from episodes 1 to 20, some of my favourites and some of yours. First, let's start with a great way to finding trading ideas suggested by Rob Hanna in episode 7. For those who aren't familiar with Rob, he had two popular blogs called Quantifiable Edges and Overnight Edges, which have since been merged into investorquant.com. In my chat with Rob, we discussed trading ideas, market behaviour, market timing, where to find the best edges, and how a confluence of ideas can improve trading results. Let's hear how Rob comes up with new trading ideas every day. So going on to testing your own ideas, you've already mentioned Quantifiable Edges, your blog, and you've got another blog called Overnight Edges as well.
Yep.
Those blogs have some very original ideas. Where do you come up with these ideas?
Well, originally, it was just a matter of testing out things that I'd read other places. And then I started trying to test observations about each day. And that's really, when people are trying to come up with ideas on, what they should test or understand what the market's doing right now, that's the easiest way to start. Just look at what the market did today and describe it. It was down 1%, it hit a 10-day low or a 5-day low, or it's coming off of a 50-day high. Breadth was this, volume was high or volume was low. Anything you can use to describe the market action, whether it's what happened today or what's happened over the last week or 2 weeks, anything you can use to describe it, you can then test. So just take a notes or make little observations about what the market is doing, whether that's whatever market you're trading, it doesn't really matter. And then what maybe some correlated or inversely correlated markets are doing as well. And you can see, you'll come up with a lot of ideas to go ahead and test things. Now, I've done a lot of those over time. So what I do after I find something that works for me or something that looks like it's promising, I'll save it. And then I built a little software application for myself that I call my Quantifinder. Or that's what I call it with Quantifiable Edges. With Overnight Edges, I have my Edge Finder. It's basically the same idea. Studies I've done in the past, it looks at the market and pulls them up for me. So if it had an edge in the past, I'll get notified that afternoon, and then what I'll do is I'll go back and retest it, because some of them may have worked years ago and may not be working anymore, or maybe they're getting stronger and working better. But I always retest. I never trust what I did in the past, because the market's always evolving and you got to adapt to it.
There could be quite a few conditions that you could test for one day. So how do you handle that? Can you run us through the process of testing ideas for a particular day?
Yeah, so generally it's hardest when the market's in a choppy mode, right? So if you're up today, down yesterday, up today, down, then you're not going to get a whole lot of things that stand out. It's when you hit more extreme, when you see extremes happening. So it doesn't when I say extreme, it doesn't, I don't mean it's got to be like once in a lifetime thing. I'm talking a 5-day low, right? Could be, that means it's extremely low in the short term, or a 5-day high, or a 10-day high or low. So you look for extremes in the data, whether it's, it's the highest volume in 10 days, whether it's the highest high price-wise in 10 days, whether breadth is the strongest in 10 days, whether measures of volatility are reaching the highest level in 10 days, or maybe they're reaching the lowest level in 10 days. You've got this real contraction going on. Both of those are giving you good information. So it's a matter of just kind of looking at things and trying to see where the extremes might lie, and keeping your mind open to, it can be, an extremely exciting thing that's happening, right? Like, wow, we've had the biggest rally in 10 days, or it can be an extremely, I guess you'd say, boring thing that's happening. Oh, it's been the tightest range we've seen in a month, right? Market did nothing today. So what normally happens after you get those really tight range days? So those are the kinds of things I would look at.
Rob goes on to discuss many other ideas and market observations, so if you're looking for ideas, I recommend having a listen to that episode again. If you want to listen to that episode or learn more about Rob, head to the show notes page for that episode, bettersystemtrader.com/7. Another guest who liked to make observations about the market to come up with trading ideas was Andreas Unger. However, he used a slightly different approach. If you're not familiar with Andreas, he is the only trader to ever win the World Cup Trading Championship 3 years in a row, also winning a number of other trading competitions over those years. Andreas was a guest on episode 16, where we discussed how to create robust strategies, the role of indicators in trading, principles to strategy creation, and optimizing to understand market behavior. Now, as I mentioned earlier, Andreas used a different approach to understanding market behavior, and that was through optimization. So let's listen to Andreas discuss how he uses optimization. Yeah, sure. So that leads nicely into a question from Thomas. He wants to know if you re-optimize your systems from time to time, and if so, when?
Well, normally this happens, it does happen, but it happens when I have some problems with the system. I look into that and I try to understand if something happened and something changed. It's not a question of re-optimizing. I'm not changing or tweaking the parameters just to get a better past result, because I believe that as it could have failed in the past, it can fail in the future, obviously. So I try to understand what happened to lead to a poor performance of a system, and I try to see if I can avoid that. There are also cases that it could happen maybe after 6 months, for example, because I'm not worried about after 3 days loss. I always wait for longer periods of time where I see that the system is really not performing the way I expected. Then I might also consider re-optimize or changing a little bit the parameters only if with the new parameters I see that the behavior is spread through all the history I have at my disposal. I'm not looking for something that just canceled the losses of the last period. I'm looking for something that showed to be stable throughout the period. It might lead to poorer results in the past where I first optimized the system, but I try to choose something that shows to be as stable as possible, hoping it's stable also in the future.
And if you've got a system that takes long and short positions, do you optimize those separately?
Oh, normally I do, yes. As I mentioned in the earlier part of the interview, I use some daily patterns, filters, and obviously these daily patterns have sometimes to be mirrored from long to short. If, for example, I decide to enter long only if the close of yesterday was smaller than the close of the day before, the short entry decision would be the opposite. So the close has to be greater than the close of the day before. Under this point of view, the conditions have to be obviously different, and I run the optimizations separately to study the market. I stress this. I run optimizations to study the market, not to find the best way to trade it. I try to study and to see how it reacts to certain conditions, and then I make the decision what to use. Sometimes I find out that, for example, for long trades, you have good results with a number of filters, while with short trades, you have good results only with a couple of them. And this is a very dangerous situation where you have to consider that all the positive results on the long side might just depend on how the market moved in the last periods. And those are very critical situations where you might consider either to take only long trades, which is bad in my opinion as a decision, unless you're trading a specific market such as mini S&P or bonds, where the situation is a bit different from also a structural point of view. Or you might decide to put into the system also some conditions which lost money in the past. But you expect that if the market changes from bearish to bullish or the opposite, those conditions you chose which lost money in the past might make money in the future because the market changes to the opposite. So that is the most delicate, but I study long and short separately to understand, to try to understand what the market is telling me.
Andrea was very clear about his use of optimization with this quote: "I run optimizations to study the market, not to find the best parameters. I study the market to see how it reacts to certain conditions, then I decide what to use." If you'd like to hear more from Andrea, head to the show notes page for episode 16, that is bettersystemtrader.com/16. Now, continuing on with the theme of analysing market conditions to determine what type of strategy to use, we move to Perry Kaufman. Perry introduces the concept of market noise and how that can determine the type of trading best suited to those market conditions. Perry began his career as a rocket scientist, working on the navigation systems which were later used in the Apollo missions. In 1971, he became involved in the futures market, and in that time has worked and consulted to a number of successful CTA, investment and prop trading groups, creating systematic trading and hedging programs. In my chat with Perry, we discussed the applications of market noise, mitigating price shocks, volatility, and using the information ratio to monitor strategy performance. Let's jump over to Perry now, where he's talking about the changes in the markets over the years and the impact technology and increased participation is having on market behavior.
As the markets became more active and more people joined, and everybody has a different opinion or a different purpose, they take money in, they out, they put money in for different reasons, that adds this underlying noise to the market. Now, for a trend follower, that means it's harder to tell when the trend starts and when it stops, because you have to wait till the move is big enough so that it's not considered noise. For the mean reversion trader, it's a little easier because it broadens the short-term area where they could make money doing the opposite of what the market's doing.
Okay, great. So just when you talk about noise, you're not actually talking about volatility, are you?
No, I'm just talking about erratic movement up and down in the market, so that, as I mentioned, or in the early 70s, you could make money with a 10-day moving average because there wasn't so much participation. The markets moved very smoothly in one direction, smoothly because the markets were dominated mostly by commercial interests and very large traders. They didn't have the individual participants. They didn't have the retirement funds. It could be interesting to the listeners that when a new market comes on board, like a country with a stock index, it is very easy to trade with a very short trend program, because they represent what our markets were in the 1960s and 70s. Very low participation, mostly commercials, and they tend to have very strong trends. And you can watch them as they get participation over a few years, they become not so easy to trade with the short-term trend, and you have to extend the period of your trend out a little to avoid the noise that's developing in that market. So if you rank all of the index markets in the world, you'll find that the US markets are the noisiest. And in this case, noisy, I'm measuring with my efficiency ratio, which measures how much back and forth movement there is given the net change over time. So the US markets are the noisiest, followed by most European, and then Asian and South and Latin America, South America. So the markets that are newer, less developed, less participation will have stronger trends. Now, that's a useful piece of information because if you're developing a trading strategy or trying to decide how you trade them, the markets with the most noise are best traded as short-term mean reversion, and the markets with the least noise are trend following. So it can be very useful for defining your strategy. And just to qualify it, it doesn't mean that from time to time you won't get a good trend. Like our index markets, which are notoriously bad for trend following, were fabulous from 2009 up to last year. But they are not normally good. But every market has its period of trending and its period of non-trending. But in the big picture, the index markets are not good for trend following programs. The best ones would be the short-term interest rates, the longer interest rates, FX. I perceive these as driven mostly by Fed policy. So the long-term trends are developed because of the way the Fed feeds in interest rate changes, which tend to be very slow and over time, which obviously affect the interest rate markets. Secondarily affects FX because money flows to those markets with the highest rate net of inflation and political instability. And then lastly, to the index markets, which are much more complex and reflect interest rates, but in a very complex way.
So that was an interesting observation from Perry. The level of market noise, as can be measured using his efficiency ratio, can be used to drive decisions on the type of strategies that best suit that market environment. If you'd like to hear more from Perry, head on over to bettersystemtrader.com/10. Now in that episode, Perry discusses some of the challenges of trend following in noisy markets, and our next guest, Andreas Lindner, has actually written a book on trend following in stocks called Stocks on the Move, and we discussed trend following with him in episode 13. Andreas is a hedge fund manager who specializes in developing and trading quantitative strategies across all asset classes. In this episode, Andreas talks about trend following in stocks, why traditional approaches just don't work, and what you can do to account for this. We also talk about trading concepts, cash versus risk allocation, position rebalancing, and building robust strategies. Now we start by asking Andreas if there is any particular component of a trading strategy that is more important than another, and he makes some really interesting points about robust strategies, so let's hear what he has to say. So what do you think is the most important component of a trading strategy? I suppose that probably depends on the type of strategy, but as a general idea, do you think there's one particular component that's more important than another?
No, it's too hard to say. It depends very much on what type of strategy. I mean, it's easy to say something like the risk management or something, but it all depends on what you're really trying to achieve. I mean, keeping it realistic is the most important thing for me. I mean, trading a broad concept and not some over-optimized. I see too many trading system ideas that are based on take these 10 indicators and optimize all these parameters, find some amazing pattern where you buy and sell based on all these indicators, and those things are never stable. They're never robust over time. I would say look at very broad concepts. Start with a broad concept. Broad concept doesn't need to be over-optimized. I mean, trading momentum, for instance, or trend following for futures, those are very broad concepts. If you implement it in a simple way, it doesn't matter so much exactly how you do it, all the details. You're trading the broad concept, not the tiny details.
Yeah, that's another interesting point I found about your book is that you actually go through the concepts before you start building a system, which I think is a good way to look at it rather than lumping a whole bunch of indicators together and seeing what sticks.
Yeah, I think it's important to start in a realistic angle. I mean, you start with coming up with what you want to trade. You can start with throwing a whole bunch of indicators on the wall and see what sticks. I mean, you're going to come up with something over-optimized that will not work in reality later on. If you don't know what you're trading and why, then probably it doesn't work. Because I start out with a broad concept that I know or have seen, have experienced, works. It could be, for instance, something like momentum, the momentum effect in stocks. I figure out first what I want to do. Say I want to do medium-term momentum in this case, in the case with the book. Well, there's not so many different ways to do it. If you know what you want to capture and how, well, you can construct a strategy that does it. You pick the strategy parameters based on what makes sense. See if it works. Try a couple of different variations. Just see if it's robust. What if I tinker with some details? I wouldn't at all do an optimization to see, for instance, if a 90-day momentum measurement is better than a 87-day, or is it 123 days? Doesn't matter. If your strategy is depending on these kind of things, it's not going to work in reality. So you need to pick something that's broad, check that it's robust, and no optimization. Then it just leads to curve fitting. Find concepts to trade and not over-optimized models.
So that was all summed up by that one quote at the end. Find concepts to trade, not over-optimized models. If you want to hear more from Andreas, then head over to bettersystemtrader.com/13. Another guest who had some insights into creating robust strategies by avoiding over-optimization and data mining was Jerry Parker. Jerry started his trading career in 1983 as one of the original turtle traders and is now the chairman and CEO of global investment manager Chesapeake Capital. He's been trading a similar style for 30 plus years, and in our chat, he shares his extensive knowledge of trend following, how to approach wins and losses, dealing with drawdowns, managing correlations in asset classes, and how changing market dynamics have impacted trend following. In this little audio snippet, we start with a question from one of the listeners on how often Jerry changes trading parameters and his best practices to avoid data mining. Jesse asks, how often have your trend following program rules and parameters changed over the years, and what best practices do you use to avoid data mining?
Oh yeah, well, we're pretty good at not data mining because we trade a lot of different systems and they don't have a lot of moving parts. I think that one entry, one exit, and a stop loss, that's the answer to data mining. So that's what we have. We never miss a trend. So our one entry gets us in the trade eventually. And the one exit, our trailing stop, will get us out if it, or we'll use the stop loss. So it can't get too much more robust than that. But I think one of the lessons that I've learned is don't tweak very often, because if you're continuing to tweak a lot and frequently, chasing these parameters around, it's sort of similar to not doing the trades, So if you miss a trade and don't follow your system, then everyone agrees that's not right. So if you continue to change your parameters, and in some ways, you're not being very consistent and disciplined, and you're chasing these parameters around only to see your old parameters start to work just fine. And I think that's the downside to all of this research that goes on, is that it harms performance sometimes. And sometimes it's just better to stick with it and be disciplined and not try to trade lots of entries and trade lots of exits, and then get rid of that desire to find the one or the couple of different systems that are going to be the best. You can't do it. It's not possible. Find a system, trade systems that keep you in the trend, but don't, try not to give back too much at the end. That's the issue. How do I stay in this choppy market? And yet, when it all does turn around, how do I preserve a good chunk of that profit so as not to give it all back? I mean, that's the puzzle. Figure it out.
Jerry's answer to avoiding data mining was one entry, one exit, and a stop loss. You can't get much simpler than that. He also said, don't tweak very often. Trade lots of entries, trade lots of exits, and get rid of that desire to find the one or couple of systems that are going to be the best. You can't do it. It's not possible. If you want to hear more from Jerry, head over to bettersystemtrader.com/17. Now, this trade lots of entries and trade lots of exits approach is very similar to a concept mentioned by Scott Andrews on Ensemble Systems. Scott Andrews is a CEO and co-founder of InvestorQuant, but was previously known around the world as the Gap Guy for his analysis of over 1,500 daily gaps. Now, if you're interested in gap trading, you've got to listen to this episode because Scott shares his expertise in gaps, explaining what factors to take into account when trading gaps and what to avoid. We also discuss gap zones, when to fade or follow a gap, and calculating stops and targets. For those that aren't so interested in gap trading, however, he discusses a concept called Ensemble Systems, which is what we're going to hear about now. It's quite an interesting way to look at combining multiple trading conditions, so let's take a listen. Now, if we can just jump back to ensembles, which you mentioned a little bit earlier, you indicated that that's a bunch of different systems. What more can you tell us about that?
Yeah, so the whole idea, again, is to reduce risk relative to return, right? Smooth your equity curve. That's what we're trying to do. I just ran out of room. And when I say ran out of room, I kept trying to put these ideas into my system, and it kept cutting my sample size down, right? So, and I'll just give you a simple example. Let's say you create 10 types of gaps, 10 categories of gaps. And if you look at those 10 categories over the past 10 years, there's been a roughly 2,000 trading days divided by 10 categories gives you 200 trades in any one of those given categories. So what I was doing, I would say, oh my gosh, I've got another great idea. What if I add another size consideration? So instead of just using large and small gaps, which is 4 total for up and down, I make 3 large up gaps and 3 large down gaps. Well, now we have 6. I've just reduced my sample size down by another third. So now my average category has about 125 trades in it. And then what if I said I want to add a 200-day moving average or something like that? Now I've reduced all the average trades down in half. So as you start adding in just a few simple ideas, you end up with too few trades to really trust the data. So what I've done is I've taken those ideas instead and organized them around my core themes. As I mentioned before, market conditions, patterns, and seasonality are my core ones. And I have systems that only focus on those themes. And what I've been doing is actually adding a couple more market condition systems because there's so many different ways to measure markets. And I only trade when the average of those systems meets my minimum desired criteria. And it's not even my desire, but a minimum level that I found gives me enough trade frequency and gives enough results. So for me, about a 60% win rate on average. So I'm looking for trades that have a 60% historical win rate because I tend to stick with those and trust them more. That means I risk a little bit more than I stand to make. And I want to know that it's made at least 15% more in profits and losses. Now, I want to be clear, that is not my target. That's not enough to account for commissions and slippage and so on. But for an average of 5 systems or 3 systems, I use 5 systems for range trades. I use 3 systems currently for gaps that will probably be expanded. But for an average, my real world results are better than the 60% win rate minimum. I'm not talking hypothetical, I'm talking about real world for several years now, better than my minimum win rate and profitability, because that's the power of ensembles. You're getting lowly correlated systems to confirm each setup. And when that happens, you're going to have much, much better results. It's the same thing. If ensemble is confusing to people, it's actually what the National Weather Center does here in the U.S. and all around the world for predicting weather. right? They use many systems with slight changes, slight iterations to predict, and they take those averages, and that creates the best, most accurate view of what's most likely to happen. The concept is the whole point here. If you're struggling or you need to improve your system methodologies, consider creating a couple simple ones. These systems are not overly complicated that I'm using in my ensembles, but they're very conceptually different, which means they're very lowly correlated. They don't really trigger at the same time. There's no unifying theme in them that makes them trigger at the same time, which is why they work so well.
In that audio, Scott mentioned that the strategies he's using are very simple, which is something that has been echoed by a number of guests. One of those was Nick Raj, who was a guest on episode 4 of the podcast. Nick is a professional trader, analyst, educator, and author. He's been trading since 1985 and now specialises in trading system design. In my chat with Nick, we discuss system design, the best type of trading systems, how to handle a bear market, measuring performance, and the difference between successful traders and everyone else. So let's head over to Nick now, where he explains why you should aim for simple systems and the disadvantages of complicated ones. So it sounds like the key there is to keep it simple and just try them out and see how they work.
I think a lot of people or don't even understand that some of these trend followers that have been in business for 30, 40 years use remarkably simple techniques. The difference is not so much in the technique to being successful. The difference to being successful is applying the approach over the longer term. I think that is the key difference between professional traders who can build a 10, 20, 30, 40-year track record and people who switch up and down systems every second day. I truly believe that simple works. Simple works as well because it's more difficult to break. It's also very easy to understand what and why the strategy might not be working at any given time. So let's use an example right there. A long-only equities trend following strategy. The types of conditions that the strategy is going to not work so well, I'm not going to say broken, that's incorrect, but not work so well would be in a very choppy sideways market or obviously in a downtrend. Now, if you have a simplistic system and you go into drawdown and you look that the market is trading in a sideways band, well, you understand why that's occurring. It's nothing wrong with the system. That's just a function of trend following that it will chop you around a little bit in a sideways market. However, if you build a very, very complex system with many variables and inputs and parameters, then first of all, there's a very high chance you've data mined or you've curve fitted for a start. Second of all, you don't quite understand why the strategy is making money, and you probably don't understand if it's not working, why it's not working. One of the most important things I try and get across to my clients is you need to understand why your strategy makes money. And trend following is just such a simple, robust way to do that, i.e. you create a positive expectancy because your winners outweigh your losers. That's the bottom line. That's what it's all about. If you can't explain why your strategy makes money, then when it goes into drawdown, you're going to find it very, very difficult to stay with it because you simply don't know why it's going into drawdown and why, if it's broken or not.
Nick summed it up nicely with the quote, "You need to understand why your strategy makes money, so that during periods of underperformance you understand why the strategy isn't going so well. Or, as he discusses later in that interview, you can implement some type of market filter to switch the strategy on and off depending on the underlying market conditions." Nick also shares a number of trend following ideas, so I recommend you have a listen to that interview if you're interested in trend following. You can hear more of Nick at bettersystemtrader.com/4. Now we're going to jump over to Cesar Alvarez, the guest on episode 3, to hear more about market timing. Cesar spent 9 years as a professional market researcher for Connors Research and TradingMarkets.com and is now the owner of the popular Alvarez Quant Trading blog. In this episode, we discuss trading ideas, backtesting, the impact and use of stops and market timing techniques. Let's have a quick listen to his take on market timing. You just mentioned market timing when you were talking about the weekend stock trader. Can you explain a little bit more about that?
Sure. I mean, in the simplest sense, and it's not what I mean by market timing is, some sort of filter or some sort of rule that I apply to let's say the S&P 500 index to say whether I want to even be considered trading the strategy. And this is not what's being used in the weekend stock trader. But, the very simple one, the one I often write about on my blog, is using the 200-day moving average. And just saying, you know what, I'm not taking trades at all in this strategy when the S&P 500 is below its 200-day moving average. Things like that, they keep you out of the market when things get really tough. Now, often, though, those are times where the strategies can also do very well, but at a cost of much greater volatility to your portfolio. So that is something, that needs to be taken into consideration. Is like if you're trying to, have higher annual returns, sometimes ignoring the market timing works to your advantage, or just changing it slightly. But like I said, I tend to focus on minimizing drawdowns, and doing that in the easiest way is just some sort of market timing indicator that just says, you know what, market's just, it's not a good time. It's not a good advantageous time to be trading the market on the long side during these time frames.
We cover a lot of other trading ideas and concepts in that episode, so if you want to hear more, head over to bettersystemtrader.com/3. Now we're going to move on to another approach which is similar to market timing, which our next guest Larry Williams describes as conditional trading. Larry has been trading futures and stocks for over 50 years and holds the record for the highest ever return in the World Cup Trading Championship, turning 10,000 into over 1.1 million in just 12 months. In this episode, we discuss conditional trading, understanding what drives prices, the misuse of indicators and how to apply them correctly. We also discuss cycles, forecasting markets, what to look for in market tops, plus Larry shares 50 years of trading insights. So let's take a listen to Larry explaining this concept of conditional trading. Can we just start by discussing your trading philosophy? Because I think I saw in another interview that you called yourself a conditional trader. Can you explain what that means?
Yeah, that's probably what separates me from other traders, as I've learned over the years that first, like probably a lot of traders, I was just taking buy signals and sell signals, but I didn't have them in the context of anything. A 3-day moving average crossed above a 7-day average. That was a big buy signal in the 1960s. And but so what? If you're in a bullish condition, not necessarily trend, but bullish condition, that signal is probably going to be enhanced and work better than if you're in a bearish condition. So finally, I got the notion that, yeah, technical stuff works, fundamental stuff works, nothing's perfect in this business, but I need to have a conditions that are usually associated with substantial rallies or declines in the market. Then I can bring in the buy signal, sell signal, the technical mumbo jumbo stuff, but I need to put that on top of a condition in the market that says, yeah, we should rally based on essentially fundamental conditions.
So Larry is only looking for buy and sell signals in the context of market conditions. So what does he do when he's found an appropriate market condition? Let's hear a little more from Larry. Okay. And so once you've seen a condition in the market that could be pointing to a specific direction, what do you do then?
Real simple. I look for another condition. I don't want to trade on just one condition. Like seasonals are a pretty good thing to trade with, not always though. So that would be one. Then I'd like to look at commercials, then valuation, then maybe a couple of my other indicators I've developed, accumulation measures, spread relationships. Oh, look, I got 3 or 4 of these things here. That's like a tumbler and, a combination lock. I get one number, go back the other way, come the other way. I got 3 numbers in place. The lock's probably going to open up. So then I'm interested in the trade. But first, it's not just one condition, not just 2 conditions. I'd like 3 or 4 conditions to really get trades that work.
I really like the analogy he gave there of a lock, where he's waiting for a number of conditions to all line up before he takes action. If you want to hear more from Larry, head over to bettersystemtrader.com/20. Now, continuing on with our conversation on entries, we're going to move to Kevin Davey, who was a guest on episode 5. Kevin's been creating trading strategies for the futures market for over 25 years and is also a World Cup trading winner, placing first or second for 3 years in a row. In our chat with Kevin, we discussed system development, working through all aspects of Kevin's system development process. He offers some really valuable insights and provides an excellent process to system development. So if you're looking for ways to improve or systematize your own development process, this is a great episode to listen to. In the interview, Kevin explains a simple way to test entries and exits using something called the monkey test. So let's have a listen to that. So a little bit further on this testing, in your book you mentioned something called the monkey test.
Yes.
Can you tell us a little bit about that?
Well, the monkey test comes from, there was a book way back when, I think, where somebody tried to have monkeys pick out stocks to buy, and their conclusion was the monkeys can do pretty good sometimes. And, but the monkey doesn't know what's going on, so it's just a random test. So sometimes what I'll do is I'll actually run tests with entries or tests with exits with randomness to it. So for example, I might run a breakout test for an entry, but for the exit, I'm going to randomly exit after a certain number of bars. And that helps you get some statistics of just how accurate or how valid that entry might be. And then the flip side, you can also do that with your entries where you randomly enter the market and you can actually test out exits. So sometimes I use those techniques to kind of get a better sense of, hey, does this exit have any merit? Does this entry have any merit? And it kind of eliminates a lot of things, because if you can kind of show some success with some randomness in there, it gives you just a little bit better idea that maybe you have something there to work with.
I thought that was an interesting approach to testing entries or exits by adding some randomness. Now, if you want to hear more from Kevin, head over to bettersystemtrader.com/5. In that episode, we also discuss walk-forward testing and Monte Carlo analysis. So, if you're interested in those aspects of trading, take a listen. Talking about exits, a common exit is the use of a stop loss. Now, some traders have varying opinions about the use of stop losses. Our next guest, Ernie Chan, discusses the use of stop losses for different trading styles. Ernie is an expert in the application of statistical models and software for trading currencies, futures, and stocks. He's built and traded numerous quantitative models for investment banks and hedge funds, published 2 books, maintains a popular quant trading blog, and teaches courses and workshops in trading and finance. Now, in my chat with Ernie, we talk about quantitative trading, momentum, minimizing drawdown and maximizing returns, automated trading, and competing with the big firms. We also talk about the use of stops in trading, so let's listen to Ernie's opinion on the application of stops. Right, so while we're talking about the market dropping, let's have a quick chat about stop losses. It seems to be a hot topic at times. People have different opinions on if they should be used and where. So what are your views on the use of stop losses?
Yes, stop loss is a very reasonable and very logical device to use in momentum strategies. And the reason is that when you are running a momentum strategy and you are finding yourself in a loss, clearly the momentum has reversed, right? And naturally, you should consider either getting out of the trade or maybe even entering into the opposite side of the trade. So the profit is telling you that the momentum has reversed. And if you're running momentum strategy, you should not keep going in the wrong direction. So stop loss are perfectly natural, and they are actually triggered, supposed to be triggered, quite regularly in momentum strategy. You couldn't possibly guess correctly the momentum direction every time. So expect to be stop out often. However, stop loss is not logical in a mean reverting strategy, because if you believe that the prices, let's say the price are dropping and you enter into a long trade, you expect the price to go up. but instead it goes down further, well, why would you be getting out? Because you are expecting that this price is even more favorable to buy. If you still expect the price to mean revert, you should be entering into more position as the price drops. So a stop loss does not make any sense for a mean reverting strategy. And in fact, if you back test any mean reverting strategy and you impose a stop loss, it inevitably decreases the profit of the back test. However, there's also there's a subtle bias here, and that is the sort of a survivorship bias in this sort of back test. In that, obviously there are mean reverting strategy that failed. It worked for a while and then the spread just keep increasing, or it worked for a while and it just bottom fell out of the market, or the opposite. And those are the strategy that we would not be backtesting. We would not be considering. We would reject them before even start backtesting it. For our mean reverting trading system. But how would we know that this good-looking mean reverting strategy that we are backtesting now is not one of those that will crash in the future? We don't. So there's always a possibility that some percentage of the strategy that seems to work now belong to the category that it will fail in the future and will never recover. So in other words, we cannot be 100% certain that what's mean reverting now will continue to mean revert in the future. And because of that, it is always a good idea to impose a stop loss to prevent catastrophe. And that is to cut off the tail risk where your strategy happened to be the one that just keep losing and will never recover. But that stop loss need to be set at a level which exceeded all the previous drawdown of your back test. Because if it is set at a level that would have been triggered in the past, it would always result in a worse back test. That would not be rational. So we would want to set the stop loss at a point where it is below the maximum drawdown of the previous of the back test. And that way it won't affect the back test, and yet it will protect us from those outlier cases where your strategy actually is one that doesn't make it in the future, and yet we will preserve your capital to fight for another day.
So Ernie's opinion on stop losses was that they're logical for momentum strategies, but not so logical in mean reversion strategies. But that's based on his own testing, so you'll need to test on your own strategies and consider your objectives to see if that type of approach suits you. If you'd like to hear more of my interview with Ernie, head over to bettersystemtrader.com/12. Now I'd like to move on to the topic of position sizing, and who better to talk to about position sizing than Ralph Vince, the guest on episode 11. Now I'm sure that anyone who's done some research into position sizing has come across Ralph, because he's a recognised authority on position sizing, publishing a number of books and papers on money management in trading. In my chat with Ralph, we talk obviously about position sizing and also the different applications of optimal F, trading horizon, diversification, and his changing views over the last 25 years. Now there are quite a few position sizing options available, so let's hear what Ralph has to say about the factors to consider when choosing a position sizing strategy that suits you.
Right, and I suppose there are a number of position sizing options out there. What factors do you need to consider when choosing one that suits you?
Well, I always say there's three of them, but they're really directed towards one. And the single most important thing is criterion. What criteria are you seeking to satisfy in your trading? If you're looking to shoot the lights out, as Larry did in 1987, that's one criteria. You might have a different criteria. You might say, I want to get the greatest return I can without exceeding a 20% drawdown. You might have another guy might have another criteria that says, I just want to make sure that when the boss calls me into his office 3 months hence, I'm profitable, that I've got my hurdle plus anything. So there's different criteria for different traders out there, and most people never really identify their criteria. I mean, the criteria for, let's say, a pension fund manager is going to be different than the criteria generally for the individual speculator. And regardless of criteria, there's two supporting legs to that, and the first one that is unavoidable is horizon, and I can get into that more, but the horizon, how many periods you are seeking to satisfy this criterion over, is absolutely essential. Absent that, you really are going to have trouble satisfying that criterion. And I don't like that, but that's just the way the math of this works out. And the second is, let's say, to what degree of confidence do you want your solution to this criterion to be? So that's really the basis behind anything in money management, I think. Detailing that criterion, and along with that, over how many holding periods, over what time period are you looking to satisfy that criterion over?
So that audio obviously didn't give too much away because it only went for 2 minutes, but Ralph did a great job of making some of the more complicated mathematical concepts really accessible. So I highly recommend you have a listen to that episode if you want to hear more. Go to bettersystemtrader.com/11. While Ralph provided us with some position sizing concepts to grow and protect our capital, our next guest, Gary Antonacci, shared some ideas on how to accomplish it using the concept of dual momentum. Gary has over 35 years' experience as an investment professional and is recognized as a foremost authority on the practical applications of momentum investing. In my chat with Gary in episode 9, we discussed the different types of momentum and how they can be used in a strategy to make profit and protect during a market downturn. Let's hear a brief explanation from Gary on dual momentum.
That leads nicely into your book you've released recently called Dual Momentum Investing. Could you tell us a little bit more about this concept of dual momentum?
Well, momentum is used in a lot of different ways, and it has a lot of different applications. But what I wanted to do was keep things as simple as possible, because the biggest danger when you're getting into rules-based trading or systematic type trading is overfitting models to your data and over-optimizing. So what I wanted to do was get something that people could use that was as simple and straightforward as possible. And for that, I did some additional research, things like Stocks for the Long Run by Jeremy Siegel points you in the direction of equities as offering the best risk premium, the highest return over long periods of time. So I figured whatever I came up with, I wanted to have it anchored in equities. And in order to get the benefits of diversification, relative strength, application of momentum with equities, you have to have more than just one kind. So the natural split to me seemed to be U.S. equities, which has offered the very best returns historically, and then the rest of the world, the all world without U.S. equities. So I figured that would be the basis of any investment approach that I had. That would take care of relative strength, momentum, to enhance returns. Now, in terms of reducing tail risk and volatility, I needed to have a different way of doing that, and that's looking at absolute momentum, which relative momentum is comparing one asset to another and going with whichever is stronger. Absolute momentum is looking at an asset compared to its own past performance. They're both trend following in the sense that relative momentum is looking at trends of one asset versus another, whereas absolute momentum is looking at the trend of the asset itself over time.
So in that short bit of audio, Gary briefly describes two different types of momentum. Relative momentum to pick the strongest performer, and absolute momentum to ensure the instrument is moving in the direction you want. Gary goes into much more detail about the dual momentum approach, so if you want more, head over to bettersystemtrader.com/9 to hear the rest of the interview. Now, perhaps you don't trade momentum strategies but are still interested in ways to reduce drawdown. Well, Brent Penfold, who was a guest on episode 2, gave some details on trading the equity curve. Brent is a full-time trader, author, educator, and licensed futures advisor who started as an institutional dealer in 1983. He now actively trades 24 markets around the world, is a published author and international speaker. In my chat with Brent, we discussed trading principles, money management, risk of ruin, and how to overcome greed, hope, and fear in trading. He also introduces this concept of trading the equity curve, so let's listen to an excerpt of his explanation on how that works. If I can just ask one more question, just going back to money management. There's a concept in your book that I haven't actually seen anywhere else. I think you may have introduced it in your Trading the SPY book. It's a concept of trading equity momentum. Can you explain a little bit about what that is, how it works?
Sure. It's a key concept that I personally hate, but it's a very important one. Equity momentum refers to monitoring our strategy as we trade it to see how it's performing. After we've done all the hard work, done all the investigation, done all the tests, and we decide to put real money behind our methodology, it is our strongest preference that the historical equity curve that we've seen in the past will continue into the future. That is, we have a very, very strong preference that the way we trade will have what I call a stable equity curve, an equity curve that's upward sloping. Now, unfortunately, not everything that we do will continue to have an upward sloping equity curve. It'll start dipping down either because, one, strategies have drawdowns, that's for sure, or it could be dipping down because it's lost its edge. And whereas before the previous 20, 30, 40 years, 15 years, it's been going up, it could be at the start of a permanent decline where the equity curve just goes down and down and down and has a little blip rally for a moment and goes down again, and a little bit of a blip rally up and think, oh, good's coming back, but then it just keeps going down. So just like in trading, with individual trading, our individual trade, we use stops to protect ourselves in the market. I believe we also need to use essentially a system stop. And so trading equity momentum is essentially we as traders saying, okay, what tool, what measurement should we use to tell us that our strategy's equity curve has come to a position where stability is in question. And if it's in question, maybe we should step to the sidelines, keep measuring our strategy, keep monitoring our strategy, but not take the signals because we're not sure what's happening. Now, just like in trading, there is no perfect individual stop for individual strategies. Unfortunately, there is no perfect strategy stop or system stop that can help us identify or measure equity momentum. Now, as an example of what I'm talking about, people may like to use a simple 50 trade or 100 trade moving average of their equity curve. And if their equity curve dips below the moving average, then that would suggest to them they should not follow the signals until the equity curve can pop back up above the moving average of the equity curve. And when the equity curve is popped back up above the moving average of the equity curve, that's when they can recommence trading the signals. That's just a simple method somebody could use for measuring their equity momentum.
So that's the concept of trading the equity curve. There's actually a lot more to it than that, but I had to cut it off due to time constraints. But if you want more information, go to bettersystemtrader.com/2. Also, if you're a beginner trader, I highly recommend you have a good listen to this episode because Brent covers a lot of topics I wish I'd known when I started out trading. Our final guest for this week's episode is Randy Howe. Randy is a personal development coach who's worked with countless traders to improve their trading performance. Now, in my chat with Randy, we discuss issues limiting trader performance, the impact of emotions, managing process, not outcome, and tips to improve trading performance. Now, as traders, we all have to deal with drawdowns at some point, and sometimes it can be difficult. Randy offered a number of solutions to some of the issues traders face, and I really enjoyed one of the stories he shared with us to illustrate a point. So here it is.
Trading is literally you let go of outcome goals, and everything is oriented around performance goals. Actually, one of your traders, basically in the system she's using, she was talking about taking the losses. The key is all professional traders take losses. And what they're doing is they're saying, do I trust the system I have? And do I have faith in my ability to deliver that system? They're not looking at their P&L statement. They know that if they manage performance, they manage their performances in the trade execution, they know that the money is going to be there. They back tested it. They have faith in that. And the key is what you're doing. You're staying very focused on how's my performance here. There is actually this is something that happened. I was watching. I really like hurdling, the race called hurdles. I tried in high school to become a hurdler, and it was a very ugly sight. But I gained an enormous amount of respect for how the body and the mind have to be trained to hurdle. And anyway, I'm watching the Olympics, and this American guy comes on, and all the announcers and journalists are talking about how he's going to win. He's just the most favored. He's the darling, and blah, 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 all this stuff. And they're just talking about him like as if he's already won the race. Well, the athletes get down, and these are really well-trained athletes at that level. And the truth is, the American just blew past everybody. And at the end of the race, he's sitting there huffing and puffing, trying to get his breath back, and all the announcers are talking about how they knew this, how that, and the other. And so they finally interviewed him while he was still, catching his breath, and they said, "What was it like? What was it like? What was it like?" And he's looking at him like, "What?" He says, "What was it like? What were you thinking when you saw that you were going to win? What were you thinking?" And the guy looked at the announcers and says, "You want to know what I was thinking?" And they literally said, "The world wants to know what you were thinking. Did you know you were going to set a world record? Did you know this? Did you know?" And he says, you want to know what I was thinking?" And they said, yes, tell me what you were thinking. Tell me what you were feeling. And he says, "I'll tell you then." And he said, 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4. And I want you to see that the announcers were projecting outcome. They were saying this is what he must be thinking. And what he was doing is he was managing performance. There is no doubt that a track coach has been working with that athlete for a number of years. There's no doubt that 1, 2, 3, 4, 1, 2, 3, 4 is a very precise mnemonic for what the body and the mind need to be doing at any particular moment in time in a hurdle race. There's no doubt that a really good sports psychologist has been working with this guy, working with the same 1, 2, 3, 4, 1, 2, 3, 4 to maintain peak performance mind during that performance. Okay? And he is not into the outcome goal. He's not about winning the race. He is about performing the race. Now later, he gets on the podium and he gets his goal thing and he runs around, he's jubilant, he's really euphoric and all that stuff. And they're interviewing him, and he's talking about how he and his team have set up these outcome goals 8, 9, 10 years ago, and how they were finally achieving them at this particular time. You can see that the outcome goals were there. But in the moment of performance, it was all process. Okay? And that's really what the trader has to learn. And it's a discipline. It's something that if you want to become a professional trader, you're just going to learn it. And you realize that it's going to be a little bit of a struggle to move from the mind that you brought to trading to the mind that produces the reliable extraction of capital out of the markets. But it's all about process and trading.
That's a great story and an excellent example of focusing on process. Randy offers a lot of other practical advice on how to overcome trading performance issues. So if you want to hear more, head over to bettersystemtrader.com/14. Anyway, that's it for this episode. Before I finish up, I'd just like to acknowledge some of the past episodes that I couldn't cover today due to time constraints, but I will mention them here because they're full of great info too. Episode 1 was Jake Bernstein on seasonality. Episode 6, Dr. Howard Bandy on system development and trade management. Episode 8 was Gary Stone talking all about market timing. Episode 15 was Stuart McPhee on trading success. And episode 19 was Jake and Elliot Bernstein on timing triggers and indicators. So what was your favourite takeaway from the first 20 episodes? Let me know by leaving a comment on the show notes page at bettersystemtrader.com/30. I'd love to hear your feedback. Now I'd just like to leave you with a short comment from Jerry Parker, which I thought was really fantastic. To hear someone like Jerry say this really hits home and sums up exactly what systematic trading is all about. So here it is.
I would just say the most important thing is to embrace the systematic approach and really believe that you don't know where the markets are going. There's no way to predict. And there's just going to be some really fun at the end. And you're going to be much happier at the end if you just totally 100% embrace systematic trading and following your system and understanding that if you follow the system, that's the right or wrong, not giving the money back or taking a loss. You weren't wrong if you took a loss. You weren't right if you made money. You just followed the system. So to the degree that you follow the system, that's how you're going to earn your grade, an A, a B, or an F. And unfortunately, in trend following, if you miss a trade, one trade, 2 trades a year, more than likely there'll be a couple of really big winners that that will going to materially impact your performance. So sell your soul, sell out to the trend and a systematic trading, realizing that you really do not know where the market's going. You can't do any better than your system.
So that's it for this episode. Can I please ask that if you're enjoying the podcast, please leave a quick review on iTunes. It would really help to spread the word and reach a much wider audience. So just go to bettersystemtrader.com/review and it'll take you directly to the Better System Trader page in iTunes, and from there it should take less than 1 minute to add a review. So show your support and thanks for your help. Anyway, I hope you enjoyed the review of the first 20 episodes. Thanks for listening to the Better System Trader podcast. I'll catch you next week.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.